It's a windy, rainy day. Glad you could make it over here. And a busy day for you. We're already speaking at the Council on Foreign Relations. It's interesting because you made it very clear. You're a voter next year. Let's put that on the table. You've made it clear that you're one of the 13 FOMC members. You must be one of the dots that sees no moves, no rate cuts, no rate hikes, unless something happens in 2020. What has to happen?
There has to be a material change in the outlook, either for better or for worse. I've already got baked into my outlook. We're going to have weak manufacturing next year, sluggish global growth, pretty sluggish business investment, but with a strong consumer. There would have to be some material change from that outlook.
Which way do the risks tilt in your mind?
I think it's fairly balanced at the moment, and for a number of reasons. I'm hoping we'll get some stabilization in trade. I think the moves the Fed has made have also been helpful. And I'd say the risks, though, are balanced.
If you see the risk tilting toward the upside and the possible need for a rate hike, would that be hard to do in an election year? Would you consider that ill-advised, something the Fed will try to avoid?
It will not be a factor in my thinking, in that I'm going to, as usual, divorce political considerations, political influences. I think we'll try to make the best decision we can in light of the circumstances, use our best judgment.
You know, you repeated this morning, as you have said for a while, you expect 2% growth next year.
Yeah.
That hasn't changed. 3.5% unemployment.
Yeah.
So it sounds to me like you don't really expect the passage of the Phase 1 trade deal to have much impact on the economy, certainly not out of the gate.
Yeah, probably that's probably correct. I'd been hoping there would be some trade stabilization generally. This is part of that. That's not to say, and you've heard me say this before, I think the trade issues with China are going to go on for years, not months, but years. I think most businesses are adjusted to that. These issues of intellectual property, technology transfer, and the much deeper issues with China are going to be going on for a long time. And so Phase 1 is better than not having Phase 1, but it doesn't mean there won't still be trade uncertainty.
Another thing that you have sort of pounded the table on for the past however long, a year and a half this has been going on, that it's not necessarily the impact of the trade war per se on the economy, though we've definitely seen the hit to manufacturing. You say it's more about the hit on businesses, business uncertainty, and what that means for investment. So may I also conclude that you think that uncertainty is not going away with a Phase 1 trade deal, a trade deal that's going to go on and on, Phase 2 negotiations that are starting immediately, according to the president?
So what I've said, and I'd still say, if it was just about the trade dispute with China, I think businesses could manage that. And I think helping, by the way, get USMCA ratified also helps. But I think for most businesses I talk to, it's the broader trade uncertainty. Here's an example. 2 months ago or so, we threatened Mexico with tariffs, even though we had a trade agreement, and that would have had a substantial effect on logistics and supply chain arrangements. It wound up not happening, but the threat was enough to cause businesses to realize, even with trade agreements, if we have a national strategy that uses tariffs as a foreign policy and economic tool, you just have to be prepared as a business. You're going to have more uncertainty. And so most businesses I talk to aren't canceling projects, but they are just saying, let's just put them on hold and let's just slow down. And we're seeing that in business fixed investment.
So the passage of the new NAFTA, the USMCA, your district, the Dallas Fed region, certainly does a lot of trade with Mexico.
Yeah, we are largest partner.
How much does it mean for your district? How much does it mean for the country?
And it's logistics and supply chain arrangements with Mexico are critical, not just to Texas, but the entire country. Having the agreement done and where you have more certainty is a positive. Will it have a material change? I'm not sure about that. Ironically, it may actually help Mexico on balance more in that their GDP, as you may know, growth has been very, very weak, and they need more business investment, and getting this passed will help them especially. But it's a positive for the United States, and it's essential to U.S. competitiveness and logistics and supply chains here.
Moving to the global economy, which is something you also talked about today, you're concerned about how weak exports, et cetera, could spread. But it's interesting to me, Rob, because the Fed did 3 rate cuts, saying the economy's in a good place. the main reason was global developments, global tensions, a weaker global economy. Well, China's expected to keep weakening next year. Germany is still very weak. So, the Fed has paused in its rate cuts.
Yeah.
So, was the real result not so much that the global economy changed because of those the Fed's 3 rate cuts, but the yield curve recovered and reassured domestic financial markets? Is that the key to what the Fed did, and your support for it?
For me, it was one of the keys. So my own judgment, if you roll back the clock to June, it wasn't just weak global growth, it was weak manufacturing in the United States, weaker than it's been since '09, and weak business and fixed investment. And I said at the time we should do modest, limited, restrained adjustment to the Fed funds rate to address those issues. But the other thing I was worried about, which you just talked about, was the curve was inverted, and I felt it would be much better if we had an upwardly sloping curve. So to me, the curve is a symptom that maybe our adjustments were about right, and it wasn't intended to solve these issues, but it was intended to adjust policy in light of these issues. And I think the curve being upwardly sloping tells me we're probably in about the right place.
So that curve is a strong signal if it were to move in the other direction again.
It would concern me.
Yes. So I want to move on to the consumer, because the Fed is putting so much impact on the consumer. While investment has been weak, this keeps the economy in a good place. But retail sales have been decelerating.
Yeah.
The November number was half what the consensus forecast was. Our Bloomberg economics team is expecting holiday sales to only come in at a gain of 3.4% over last year. That will be the second weakest of the cycle. What if your main engine of growth is starting to kind of run out of some gas?
Well, I don't think that's going to happen, and here's what I'll be watching for. I've been worried that weak business investment and weak manufacturing would seep into other parts of the economy. We haven't seen that yet. And so even if any given month or quarter consumer spending is a little weaker than it might have been, there's no doubt the consumer balance sheets are not perfect, but they're in much better shape. And we've got a very tight jobs market, and there's no evidence I see that the jobs market is doing anything but getting tighter. That's a pretty good tailwind for the consumer. So unless something changes that causes employment picture to change, the consumer is going to be solid for next year. That doesn't mean in any month or quarter they're going to spend, but I'm telling you they have the capacity to spend. And so I think that's a pretty good underpinning for the economy.
The other side of the policy coin, as you get ready to cast those votes in 2020, is inflation.
Yeah.
And at the press conference after the meeting last week, Jay Powell said he would have to see persistently rising inflation to get on board with a rate hike. Mm-hmm. What's your position?
We've been in a situation where we've been able to run a very tight labor force without inflation taking off. We've had muted inflation. I probably would have this is what's great about the FOMC, we all have a little bit different take on this. I'll be looking at what potential growth does. I'll be looking at what the trends are in the labor market. And yes, in addition, I'll be looking at where we versus our target. But I'll be looking at a range of factors. And I'll also be looking at financial stability issues in weighing whether some action is appropriate. And I'll be looking at that broad menu.
Longer term, University of Michigan inflation expectations, the recent survey, matched the record low of the survey, which has been going on for decades, at 2.3%. Does this concern you?
Well, it doesn't surprise me, and here's why. We've had in my view, and you know I've been talking about this the last few years, we've had a substantial structural change in the U.S. economy, from technology to technology-enabled disruption. The fact that everyone out there has in the palm of his or her hand more computing power than most businesses did 10 years ago means the balance of power has shifted. Businesses don't have pricing power. And so because prices have been low, it's not surprising that consumer expectations are they're going to stay low. And so does it concern me? No, I think it's reality. And we just have to acknowledge that the reality of technology and lack of pricing power is with us to stay.
Here's something kind of puzzling to me. Because the dots, if you look out to 2021 and 22, suggest the Fed will start tilting toward rate hikes.
Yeah.
But the consensus inflation forecast is in a range for something like 1.8 or 1.9 to 2.2 for the core and the headline. And the FOMC's been talking a lot about letting inflation overshoot because it undershot for so long, for so many years, has not hit its target. So it looks like that's not the Fed's position, that as soon as you see it at 2% and higher, boom, we better start hiking rates. What's Rob Kaplan's position?
So be careful to talk about what the dot plot is and what it isn't. All it gives you is a snapshot in mid-December on every quarter date on what my best guess is on what rates are going to do. The reason some people or I may have put in a rate increase, one in 21 or in the out years, is just thinking we may get to a point where growth is starting to trend above potential. Maybe inflation is starting to meet or exceed our target. But I don't know if that's going to happen. I still think my view is I'd be willing to tolerate some overshoot of the 2% target as long as it's not persistent. If I thought it were persistent and was going to last, I would want to do something to adjust rates. That's a little different tolerance than we've had historically, where as we were approaching 2 and had a tight labor force, we thought we had to move. I think there's a little greater tolerance to take a little bit more risk on a little bit of an overshoot, and that's probably where I am.
So it doesn't sound like much, though, Rob, tell you the truth. I mean, especially after, what's that, you make it up or you don't make it up. This is not about making it up.
Well, you see, on the makeup strategies and that whole concept for your viewers of averaging, I think it's important to look at whether we've been running behind. I think it's important to look at averaging, but I think there's no substitute for using your judgment when you get into the situation, and I don't want to forego using my judgment based on the circumstances at the time.
Why don't we move on to the repo injections? We've been involved with this for so long. We remember when the Fed used to do custom RPs and reverse repos day in and day out. That was ancient history before the crisis.
Yeah.
Now these reserve injections to add liquidity, prevent market instability, have gotten so big that people are saying they rival what was done with quantitative easing, 3 rounds of quantitative easing. Will you tell us that these injections won't have the same impact as QEs?
Well, they're just, again, so QE for people watching is when we buy Treasury securities along the curve. Right now we're buying bills, and we've announced a limited amount, $60 billion a month for some 5 or 6 months. Now, because money is fungible, if we're buying bills, some would argue it must be having some depressing effect on the rest of the curve. And as a former markets and as a markets person most of my life, that makes sense to me. So it's having probably some effect. We're trying to limit it. And my own, so I can't make a categorical statement, but we did make a judgment, and I made a judgment along with the FOMC, that we've let the balance sheet maybe run down a little bit, and we needed to increase reserves in the system because of tax payments, debt issuance. But I do want to see, after we get past year end and into early next year, I would like to continue the debate about what our strategy ought to be to have the smallest possible balance sheet consistent with an ample reserves regime. And so we probably have more debate to have on that subject, but after we get through year end.
And even Jay Powell said at the press conference, I've got a lot on my plate besides a standing repo facility. I want to bring in my partner in watching Federal Reserve crime, Vonnie Quinn, something we've done for years. Vonnie, I know you've got some questions for Rob Kaplan as well.
Hi,
Absolutely, Kathleen, and thanks very much for visiting us again, Rob. You mentioned weaknesses, and I'm just curious because corporate debt trading at distress levels reached a high in November. We're at 130 billion almost, and CCC spreads have blown out now to about 900 basis points just in the last few weeks. How concerned are you about that area?
So when I see triple C spreads widen, I'm not concerned. I'm actually more encouraged. What gets my attention more is that single B and double B credit spreads are so tight. Triple B spreads are very tight. If I see evidence that the market is sort of distinguishing between lower quality credits and better credits, I actually think that's an encouraging sign. My bigger worry is you've got increasing PEs, you've got historically low cap rates, you've got very tight credit spreads, and I'm just keeping a close eye on excesses and imbalances, particularly when corporate debt is historically high. Triple B debt is tripled, double B and single B debt has increased dramatically, and I'm cognizant of that and watching it carefully to make sure we're not creating excesses, undue excesses and imbalances that are hard to deal with later.
On another note, your new colleague in central banking, Christine Lagarde, the other day specifically called out the words hawk and dove as being unhelpful and introduced the word owl. And it was more than just a little bit of humor. I think there was a point there. Should hawk and dove, should those categorizations go away, or are they helpful?
Well, so as someone, I've been called a hawk, I've been called a dove, and I've been called a centrist. I think for me, the most important thing that a central banker does is assess the facts and face reality and avoid being predetermined or ideological. So in that regard, I think these labels, you want to avoid them. And more importantly, I want to avoid acting like one of those labels, because when circumstances change, I need to be open to adapting to that.
Speaking of circumstances changing, we have had some changes in the last couple of weeks alone. If the ECB first, if it tries to bring rates back up to zero from negative next year, how does that change the calculus at the Federal Reserve?
Well, I've said publicly I'm not a fan of negative rates, and my concern about negative rates, it may be an example of the central bank trying to do too much and the need for broader economic policy. And I'm fearful about negative impacts on the financial system. So I could understand why the ECB might want to do that, and I would like to avoid negative rates here in the United States. I don't think it's it's an alternative we have, but I'm not sure it's a constructive alternative.
My point, I suppose, though, is if the ECB does try to lift rates a little bit from where they are, does that mean that US rates automatically get a boost, and does that change the calculus?
I don't think so. And the set of issues they're dealing with in Europe is different enough from ours that I could understand. I could understand them taking action, and it might have no implication, in my judgment, for what we do.
One question on England, Britain. We obviously have a big change underway. Deutsche Bank is now looking for the Bank of England to cut rates in January, Bob, right. And obviously there's a lot of concern at the Bank of England. The capital buffer on banks, for example, doubled yesterday to 2%. Curious as to your thoughts on how the British economy has changed.
So, for better or worse, my own judgment has been, and I've been vocal about this, I think globalization is an opportunity for countries like the US, UK, and others to grow faster. Obviously, the trend right now, I'd say, is toward deglobalization, and it just means slower growth. And so what you've seen in the UK, for example, is they've depreciated their currency because the economy's been weaker. It's helped stabilize things. But I think they're going to have to, their challenge is going to be how to grow faster and engage with the rest of the world in light of Brexit, because I think globalization is still, all things being equal, is an opportunity, not a threat. It's an opportunity to grow faster.
All right, on that positive note, I'll send it right back to you, Kathleen.
Well, and I want to follow up on Vonnie's questions about the global economy, because you said earlier today that you were concerned. I just want you to explain that a little bit better. You're concerned about a dynamic that could take hold where very export-dependent countries like Germany, about 40%, it's the most export-dependent country in the world.
Over 40%.
Exactly. China and across Asia, where that doesn't get better, where maybe that deepens. Because we know the impact, whatever happens on the trade deal, is not going, and that could infect the United States.
It could.
What do you mean by that, and how big of a risk is that to the outlook?
So let's start with my base case for next year is global growth won't be spectacular, but I'm hopeful it will stabilize, and I'm hopeful some of this trade uncertainty will stabilize, which will help that. If it doesn't, it will affect the United States. And by the way, the best example of that is the energy business, where the price of oil is lower. CapEx for the energy business, we think this year has been down 5 to 10%. We think it'll be down 15% next year because of the lower price of oil and profitability challenges and capital discipline. And so lower global growth, more sluggish global growth is, we're not immune to it. Almost half of our company's S&P 500 revenues and profits come from outside the US. So I'm hopeful that we'll stabilize and even see some improvement in global growth, but the point is it matters, and trade is central to whether or not we get better global growth.
So this is still a big risk hanging over the economy
It is.
that I think raises a big question about the solidity. And I know the dots are a point in time. Nevertheless,
Yeah.
whatever anybody was looking at the meeting, at the FOMC meeting, you all must be saying this assumes that things don't get worse from the trade war, and maybe they start getting better. That's a key to saying we don't need to cut rates more.
Yeah, and by the way, that is my most likely case we've had a rough year. How's that? I'll call it rough in terms of global trade, and you've seen that reflected in global growth. My base case is it's not going to get worse next year. It might stabilize. If that's not true, I'm going to have to take a hard look at that.
I want to ask you about the dots. I have this funny idea because you're doing the review, the monetary review, and you're going to change things.
Yeah.
Many Fed officials love the dots, think they're very important, even though they can change, that they give an idea of where people are going.
Yeah.
How about just agreeing to this? Just showing dots. You could show different colored dots, red dots and green dots, to show who the voters are and who the non-voters are. Something like that. Just giving us a little more transparency. What do you think, Rob Kaplan?
Well, so I'm part of the communications subcommittee at the Fed, and with the FOMC, we're taking a hard look at how to improve the summary of economic projections, the SEP, the dot plot. And so we'll come out with some improvements to it. I, by and large, think it's still a useful tool. It's one we ought to keep, but I think we can adjust it to make it a little more effective. But I think it provides a lot of transparency and guidance for the public as to where we're heading, but I think we can improve it.
How?
I actually don't want to foreshadow. We'll come out with those. I don't want to dribble out what some of those improvements might be, but you'll see us do some things to enhance it, and we'll announce those in the first or second quarter of the year.
I love it. There's one more question on my list I didn't ask you, and thinking about oil makes me think about it. The latest producer price index was soft, and even services prices are starting to weaken.
Yeah.
And you can't pin it all on oil prices.
No.
Again, when you look at the global economy, when you look at the pipeline, does that concern you?
Well, it's what we've been expecting at the Dallas Fed. So we use a measure of core inflation, as you know, called the Dallas Trim Mean, that X's out, moves to the upside and the downside. That's running about 2%. Having said that, it's my view that pricing power of business has deteriorated, and I think it will continue to, because of technology and technology-enabled disruption. And I see that in every call I make with CEOs. I talked about 30 a month. In all of our surveys, if anything, pricing power is deteriorating. And to the extent companies have wage pressure, it's more likely to come out of margins than be passed on in terms of prices.
Really quickly, that doesn't sound like an inflation threat to me.
I think inflation is going to be muted for some period of time because of these structural changes, and I'm very mindful of that. It's not running away from us.